Thanks for taking the time to join us at IBK webinars here, and thank you to Matt Cashman, who is the Principal of Investor Education over at the OCC in Chicago. How are you, Matt?
That is true. I am the Principal of Investor Education at OCC in Chicago. I'm doing pretty well today, Andrew. How are you?
Jolly good. Yes, I'm back in the saddle. I'm good. You're going to be talking about the relationships between implied and historic volatility, amongst other things, but you're going to put volatility in context. Tell us, please, Matt, what have you got in store?
Yes, sir. So relative value is kind of a buzzword that gets thrown around an awful lot, and there are entire trading desks that are built around the idea of relative value. Relative value is essentially the idea that one thing only has a value relative to something else, and that's the only thing that you care about. You care about the relationship between those two things. You don't necessarily care about the overall level of this thing or this thing. You care about the relationship between them. And so we're going to take that idea and we're going to bang it on top of implied vol and delivered vol, historical and implied vol, and we're going to talk about what that means and how it moves around and how you can think about it.
All right, fantastic. Up on the screen right now are the disclosures from Interactive Brokers Compliance Team, who always ask me to display this slide, and it'll be available in the replay too. You'll get a link to the recording a couple of hours after Matt has wrapped up here today. Matt, I'm going to make you the presenter so that you can take over the screen here and get into PowerPoint. And let's see, any questions for Matt throughout? Please do put them into the chat panel or the question panel. We're going to run a Q&A towards the end. Matt, I'm also going to make you the organizer so you can see any questions coming in. You might lose audio for a few seconds, but don't panic if you do. We've got a good turnout today. The handouts that Matt has prepared are available in the GoToWebinar tower there. Just expand the handouts section and click on the link to the PDF and you can download. Matt, please take it away.
Amen. Thank you, Andrew. I appreciate it. This is our disclaimer. It might look very similar to the IBKR disclaimer because all disclaimers kind of look the same, but options involve risk. They're not suitable for everyone, et cetera, et cetera. Take a look, have a read. Hello, everyone, and thank you for joining us today for today's IBKR and OIC webinar. We're calling it Relative Value Framework. We're going to talk about relative value, what it means, how you can use it to think about options, implied vol, and movement of the underlying, and how you can think about it when the options inevitably start to reprice, because that's what they do. That's what options do. The topic is going to be a little math heavy today. I'm not going to lie to you, but don't run for the hills just yet. The math is very, very simple, and that is intentional. The idea behind this entire framework is to help you to remove some bias as to what is high and what is low, and instead compare things to how they're priced going forward with how things have moved in the past, and to use these simple ratios to contrast both of those things, the implied vols, which are the forward-looking vols, and the delivered vols, which is how much something's moved in the past, and compare those on an ongoing basis as a framework to be able to figure out what is going on. So with that said, I want to give you a little bit of background on what we do at OIC. I'm the Principal of Investor Education at OCC, as well as an Options Industry Council instructor at OIC. I started trading in '98. I've been an options trader ever since. I've worked a couple of different places trading options, but always trading implied vol and relative value. And always trading options wherever I have been. So I started trading in '99. I've been trading over 25 years. Now my job is to teach people how options work at OIC. OIC is the Options Industry Council. This is the place where you can go to get free and unbiased professional options education, optionseducation.org. This website that you see right here is where all of our educational resources are held: online courses, podcasts, videos, webinars like the one that you're watching now. Or here's another resource that doesn't get used enough: options at theocc.com. I just saw a stat today that said We answer somewhere north of 4,500 email questions every year on the investor education desk. This is where you send email questions if you have them about options. Amongst the four of us that sit on that investor education desk, we have over 100 years of options trading experience. So make sure to send us email questions when they arise. The following trademarks you'll see used throughout. They're owned wholly by the OCC and the OIC, et cetera, et cetera. Let's dive right in. So we're going to talk about historical and implied volatilities, what they mean. Then we'll dig into what is relative value. What does relative value mean? We'll talk about the ratios and how they actually get put together and how to interpret them. And then we'll talk about how they might move over time and what that might mean for the actual option prices. I'll interpret that relative to straddle prices because that's usually the easiest way to look at it. And then we'll talk about possible bumps in the road and have some time for some Q&A, hopefully. So historical and implied volatility metrics. Historical volatility is merely how much something has moved over the last N number of days. So if you're looking at a 10-day historical vol, what you're looking at is how much that thing has moved over the last 10 days. And if you're looking at a 30-day historical vol, you're looking at how much that thing has moved over the last 30 days. Generally speaking, this is measured on a close-to-close basis, not intraday. So oftentimes you'll see something that moves up 2 standard deviations, down 1 standard deviation, and closes unchanged. If you're measuring that on a close-to-close basis, that's going to be a 0, right? It's going to be that thing didn't move. However, if you go back and you look at the actual intraday historical vol, that's going to be a different number. But most of the time, people who measure historical volatility like this and use it for this reason, measure it on a close-to-close basis because they usually hedge on a close-to-close basis as well. So regardless, historical vol is backward-looking. It's a statistic. It's a fact. It's not a prediction. It is not a forecast. Contrast that with implied volatility. Implied volatility is forward-looking. Options and only options have implied volatility. It is the main input for option pricing models, and it reflects the current forecasted volatility assumptions. Remember, this is forward-looking, forecasted volatility assumptions with respect to current underlying price and movement. It reflects the marketplace's general consensus for how much this thing is going to move going forward. And just like if you're looking at a 10-day historical vol, you're looking at how much something has moved in the last 10 days. If you're looking at a 10-day implied vol, an implied vol for an option that's going to expire in 10 days, what you're looking at is the market's best guess for how much that thing's going to move over the next 10 days. So that's the way I want you to think about it. I want you to contrast these two things. Implied volatility is the consensus of all the market participants because it is built into the price. It is commensurately tied with the price. So anytime an option has a price that's trading, it also has an implied vol that is linked to that price. That is something that people don't always necessarily understand, is that implied volatility can move around. It's exceptionally dynamic. Just like price is dynamic, implied volatility is dynamic as well. So when you think about this, I want you to think about this as two sides of the same coin, with historical volatility being to the left and implied volatility going to the right. Today is in between those two things. Options implied vol reflects what people think is going to happen. Historical or delivered vol reflects what has happened previously. And in between them is today. That's what makes option trading hard, is that today you have to make a decision about what you think is going to happen in the next 10 or 20 or 2 days or 30 days. And the only thing you really have at your disposal is what has happened previously and how much this thing is priced now. What is it priced at now? What are the expectations going forward? And do I want to buy or do I want to sell that number, essentially? So with that said, what we're going to talk about today is the relative value model as to why things and how things can be thought of relative to each other and relative to their own delivered volatility or historical volatility. Relative value is a framework to evaluate historical vol against implied vol. It's generally expressed as a ratio. Now, not everyone expresses it this way, but this is the way that I choose to express it because I think it's the most simplistic way. I always look at relative value ratios as implied volatility divided by historical volatility. I would suggest if you're going to do this and start thinking about things this way, just make a decision as to whether you want implied vol on the top of the ratio or historical vol on the top of the ratio, and then never change it. Because what it does is it gives you a very stable framework within which to look at things going forward. I like to think about implied vol on the top of the ratio because that's the one that can move around a lot more than historical vol most of the time, and it's tied to the optionality. And so I like to think about it as the forecast divided by what has happened in the past. The idea behind this is that the simplicity of this allows for a lot of different use cases. The ratio is always expressing essentially one asset in terms of another asset, or one volatility in terms of another volatility. The power of this ratio is in its reductive potential. It can be used to compare implied vol to historical vol, or implied vol to implied vol, or guess what? Historical vol to historical vol. We'll talk about all of those. But the key to this is that you can use it in lots of different ways, and you can use it across asset classes, and you can use it within the same asset class. You can even use it within the same product by looking at, for instance, month, like December vol versus Jan vol, or Jan vol versus March vol. Those things can also be useful. Once you learn the idea of relative value, you can apply it in lots of different ways. So let's build a picture of what we're talking about here by using some forecasted and some underlying movement vols. So we're going to talk about the 10-day implied vol, the 30-day implied vol, the 60-day and the 90-day implied vol for two different stocks. You can think about this as like a kind of weekly option, basically right here, right? A monthly option, a 2-month option, and a 3-month option. And that's the way that I would really look at that when I'm looking at what these vols look like over time. So for stock one, we can think about this as the 10-day, the 30-day, the 60-day, and the 90-day. The 10-day is priced on a 65 vol. The month vol is priced on a 35, a 22, and then a 17 as you go out in time. Contrast that with the second stock, stock two, which is essentially priced somewhere around a 16 to a 17 vol, regardless of the duration of the options. So this suggests that the market is forecasting more movement in stock one in the next 10 days, and then have less movement over time, whereas in stock two, the implied volatility curve is basically forecasting the exact same movement regardless. Now, let's look at the same 10-day, 30-day, 60-day, and 90-day vols, but these are historical vols. These are looking backwards. These are a measure of how much those same stocks, stock one and stock two, have moved over the last 10 days, 30 days, 60 days, and 90 days. The reason why we do this, the reason why I think it's helpful to do this, is that sometimes people talk about volatility clustering around certain events, certain times. You see a lot more volatility that begets more volatility. I get a lot of questions whenever I talk about this as to, well, you know, like past performance is not indicative of future results. You have it in your own disclaimer. That is true. I do have that in my disclaimer. However, I do think that volatility does cluster and that it can be helpful to build a framework to be able to understand how much something has moved and how much of that is being priced into the next same number of days. So in this case, you see stock one as having a much higher 10-day vol, right? It's moved on a 58 for the last 10 days, 30 on the last 30 days, 20 and 12 on the 60 and 90 days. So this historical volatility number tells the same basic story for stock one. It's moved a lot over the last 10 days and not so much over the last 90 days. Stock two has much less variance in its shape and more of a narrow range. Now, what I'm going to tell you is to get to the relative value part of this, you're going to divide the top number by the bottom number. And what we end up with here is implied historical vol ratios for each one of these stocks, stock 1 and stock 2. The 10-day ratio for stock 1 is a 112, and the 10-day ratio for stock 2 is a 108. And then you can see this going backwards over time. What this gives you is an idea of how much the vol is pricing in and how much that same number of days previously has actually delivered. When you express these numbers as ratios, they start to tell their own story relative to the actual implied vol story that is being told here and the delivered story that's being told here independently. It's not always evident, though, in looking at the individual vol numbers on their own, what could a higher ratio tell you relative to a lower ratio. In most cases, and this is part of the reason why I said at the beginning, stick with one implied or delivered on the top of that ratio and always stick with it that way, because that gives you a really quick way to look at something and say the implied is trading over the historical or the historical is trading over the implied. And we're going to talk a little bit about how you can interpret these ratios. So let's look at example 1. We have a 30-day implied vol of 20.25 and a 30-day historical vol of 15 for stock 1. And then we have a 58 and a 43 for stock 2. These are both 30-day numbers. One of them is looking forward, implied vol. One of them is looking backward, the 30-day historical vol. What do we get here? We get the same ratio, a 1.35. That essentially means that the implied volatility is 135% of the delivered volatility for that same amount of time. Now, I'm going to stress this again. One of these looks forward, implied vol. One of them looks backward, delivered vol. So what we are doing is we are looking in opposite directions from today. But what this does tell you is that regardless of the overall level of these vols, right? This is a 58 and this is a 20. You can still have a 135 ratio based on where the historical vol is relative to the implied vol. And this is the concept that I want to drive home as far as removing bias. Some people might look at this 20.25 and this 58 vol for a stock 1 and stock 2 and say, oh, well, that's low and that's high. But the real situation here, when you compare it to how much those two stocks have been moving, is that they're priced exactly the same way relative to movement. And that's the difference in figuring out how this kind of colors the way that you think about optionality and price. To that end, let's look at another example. The 30-day implied vol is a 19.5 for stock 1, and the 30-day historical is 25. And then on stock 2, you have a 73 and a 93. Both of those, even though they're massively different in both historical and implied vol, this is a 19.5 and this is a 73, and this is a 25 and a 93. Those are completely different numbers, different universes totally. However, when you compare them to each other, they're both a 78. They're both a 0.78 ratio of implied vol divided by historical vol. Again, it would be very easy to look at these two numbers, the 30-day implied vol and the for stock 1 and stock 2, and see them as 19.5 and 73 and think one of them is low and one of them is high. And in reality, sure, you could say one of them is low and one of them is high, but when you zoom out a little bit and you incorporate how much things have been moving, it tells a totally different story. And then we have example 3, where essentially implied vol is roughly equal to historical volatility. Again, we have a 15.5 and a 75, but when you compare them to how much their stocks are moving, you still have a 103 ratio, which is very close to equal historical vol and delivered vol. Implied vol and historical vol. So this is meant to show you that no matter what, you can have a situation in which the implied vol is 135% of its actual delivered, regardless of whether the vol is a 20 or a 58. It's really a measurement of the implied vol versus how much it's moved, not the implied vol on its own. And that's the real magic of this entire idea. So what can these ratios tell you? So in this situation, this is the situation that we just talked about, where it's pricing on a 1.35. That means that implied vol is higher than the commensurate duration of historical volatility. Some people would look at this and say, this is expensive relative to its own historical volatility. One possible explanation for this would be something like a forecasted event on the horizon. Sometimes you will see, and if many of you have traded things like earnings, you will see that implied vol gets pumped into a curve before anticipated movement, that it's built in from a price perspective because people are trying to figure out how much uncertainty should be included in the actual option pricing. And after that happens, generally speaking, that same event kind of comes in as far as implied volatility is concerned as the actual underlying kind of like anxiety about movement is pulled out of that situation. When people become more sure of things, they tend to sell implied volatility or lower implied volatility as certainty becomes more a part of the horizon. And so in this case, what you're really seeing is that implied vol is just higher than delivered vol over the same period of time. This can be for lots of different reasons. The earnings situation that I just explained can certainly be one of those reasons, but there's all kinds of reasons why this can happen. It's important that you understand that it's really just a function of measuring one relative to another and then trying to figure out whether or not that matches with how you think about how much it should be priced relative to how much it's been moving. So in this case, you've got a 135, it's 135 of the delivered. But in this case, you have the exact opposite, where the implied vol is trading under the actual delivered volatility. So this set of metrics tells the same story, but in reverse, about the implied vol being lower than the actual delivered vol. This is a situation where you can think of, let's say, one possible way you can think about this is that the underlying has moved an awful lot over the last, let's say, 30 days. And then the market is forecasting a resolution to that period and thus lower volatility for the next 30 days. And in that situation, what you would have is a particularly high delivered number that includes the last 30 days of movement, but the market saying, yeah, that happened, but then this thing happened, and we don't really expect it to move quite as much over the next 30 days. And in those situations, you can get ratios that are well under 1 or 1.0. In this case, it's 0.78. That means it's 78% of the historical vol for the same period. What I want you to think about when you think about this is, what does this actually tell me about what's going on here? This ratio that we're talking about here, this was the third one that I showed you in that first slide, is basically priced right around the same level, 30-day implied, 30-day historical, right? One of them's a 15.5, one of them's a 15, and then on the other one of them's a 75 versus a 72, 72.5. These situations generally occur when the metrics of those two line up and they're closely linked. Oftentimes you can see situations where when things are moving around just enough to keep things interesting and the implied vols are kind of doing the same thing, you'll see levels where it's priced in a way that's not that far off. It's not uncommon for people to see 103s, 105s, 110s, things of that nature. And generally speaking, I would say it's probably more likely to see an implied historical ratio that's over 1. Implied vol generally trades as a premium to the actual historical vol, but that's not always the case. So I don't want you to look at this and think if you see something that's well under 1 that there's just that it's some like crazy buying opportunity for the vol. It's really just, you know, it could be exactly what I explained earlier, which is there has been an enormous amount of delivered volatility and the implied volatility is not factoring that in going forward. Now, here's the best part about this. You can look at this in the same way that you look at a stock price, especially now because of the way that we have daily volatility and zero DTE and options that are expiring on a daily basis. What you basically have, especially in those asset classes where there are zero DTE options, is a rolling daily implied vol number that gives you an idea of how much people think things are going to move. Just like any metric, you can actually graph these ratios over time and look at them on a day by day by day basis. And you can have a rolling 10-day implied vol and a rolling 10-day historical vol that just tells you where each one of those things is moving back and forth. This is like a 20-day implied over historical vol ratio. So the ratio rallied for the first 10 days, right? Day 1 to day 10, it went from a 0.8 to a 1.5. This tells you that one of those things is moving or both of them are moving, but the implied vol is moving higher than the delivered vol when you measure it implied over historical, or that the historical vol is cratering relative to the implied vol and it's staying the same. But what I'm telling you is that you can't always just look at this and know exactly what is happening. This is one of the drawbacks of this entire framework, is that if I just plop something down in front of you and said, this is a 1.5 ratio, and now it's a 1.1 ratio, I can't tell you whether or not the implied vol went down or the historical vol went up. But I know it's some version of either or both of those things. If the vol ratio is going from a 1.5 down to a 1.1, I know that either or both of them are moving, and they're moving in opposite directions, essentially. So also, when you're looking at this, right, many times people like to use this as a way to give them a framework as to where implied vol kind of likes to live. When I used to look at this on a daily basis and have all these crazy spreadsheets that I built to evaluate this, what I was really looking for was, and I use this in the gold and the silver market and soybeans, soybean meal, soybean oil, mainly commodities markets, but I definitely used it when I traded SPX after that, and I've used it consistently throughout my trading career, is where do these ratios like to live? Because oftentimes you'll find that they like to live in certain kind of ranges. But I want you to think about it in a way that allows you the flexibility to be able to, when something potentially breaks out of a range that makes some other new high or new low in the ratio, I want you to think about it in terms of, well, what does this really mean? Why is this thing moving in the way that it's moving? Because what you need to do is always, when you see something move in these ratios, you have to, the ratio itself by design is so simplistic that you have to dig in and figure out which one is moving. Is it the numerator that's moving? Is it the denominator that's moving? Why is it moving? Did we have some massive day that has come out of the last 10 days of historical vol that has changed that historical number? Does that matter? Does that change how I think about optionality going forward? And this is why I want you to think about, when you see these ratios move, how and why are they moving? Because of the nature of these ratios, you can't exactly tell why they're moving initially. You have to dig a little bit. This requires a little bit of work. A move up in the ratio doesn't always mean that things are moving higher on the implied side. A move higher on the implied side, or a move higher on the ratio, could mean that the implied vol is staying exactly the same and the denominator is dropping. Right? That could be that. It could be that the implied vol is moving higher and the denominator is staying static. There's lots of different ways that this can move, and can move to the downside. Numerator down and denominator steady, or numerator stays steady and the denominator moves up in value. Both the numbers move, but one moves more than the other, relatively speaking. The best part about this is that it gives you a picture of what's happening but it also gives you some sort of motivation to have to dig into why it's actually moving the way that it's moving. I think that's interesting. Some people look at this and say, this is too much work. I don't want to do this, but I think it's actually a way to really build a better framework around how things move. So let's look at how the ratio can move up. So in this case, we have 5 days across the top and their commensurate implied vol numbers and 30-day historical numbers. This is for one stock, okay? So day one, you can see what they are, right? 15 over 20, that gives you a 0.75. Then the ratio moves to 0.83, 104, 112, 125. This thing is moving a lot. Why is it moving? Take a look at these and you tell me why it's moving, because it's pretty obvious when you look over the course of those 5 days that the implied vol is moving higher than the actual delivered vol. The delivered vol is static, right? It's a 20 the entire time. This tells you that this ratio is moving higher because the implied vol is moving higher. This can happen on the other side too. You can see something move. Look at these implied vols. It's moving from a 25 down to a 15. And again, that 30-day historical number is staying the same. What is that going to do? That's going to tell you that this ratio is moving down, but it's moving down because the implied vol is moving down, not the historical vol. The historical vol is staying static. Now, we can also look at, like I said, the reason why this ratio can move up is because implied vol stays exactly the same, but the delivered vol craters over the course of 5 days. You see this thing go from a 25 delivered vol right here down to a 15. This could be 2 or 3 days of exceptional amount of movement that are coming out of that data set, and they come out one at a time, and you get a big jump down and then another big jump down. That can be what can happen here, but the real crux of the matter is that, guess what? The ratio is still moving up. It's just that implied vol isn't actually moving up. Implied vol is staying the same. And then you can also see the ratio move down when 30-day historical vol moves up and implied vol stays exactly the same. Some people, like I said, look at this and think, this is confusing. I don't really want to look at it this way, and that's fine. I think what this does is it gives you a way to look at and dig into why things are moving, where the movement is coming from, and is it coming from the historical vol that's already happened, or is it coming from the measure of implied vol, which is a forecast of what is going to happen? It's a way to center the actual movement into either what is being talked about in the future or what has happened in the past. And that, I think, is the exceptionally useful part of this. Now, both of these vols can also move, right? Both vols are moving here. It's just that the 30-day historical vol is moving faster to the downside than the implied vol is. And so what you get here is the same movement up, but both of them are moving kind of like all over the place, but over the course of that 5 days, you get 30-day historical vol much lower, and thus the ratio goes up because the implied vol stays relatively the same. And then you can also have the ratio moving down because 30-day historical vol is moving up over time, and that's going to give you a lower ratio over time. Again, the idea here is to think about where's the movement coming from and why is it moving in the way that it is. You can contrast that to a certain situation in which you would look at this and say, well, if all you were looking at was the implied vol over these 5 days, and you saw that it was a 19, a 22, a 19, a 22, and it settled in a 20 on the fifth day, you might look at this and just be like, there's nothing happening here. And that might be the case. There might be nothing happening there. However, if you were selling that implied vol and the 30-day vol, the actual measure of how much the thing was moving, was changing significantly over those 5 days and went from a 16 on day one and rallied to a 19.5, a 20, a 24, and a 25, and you were short options, you wouldn't necessarily lose money because you were short options and the implied vol was going higher, because it really isn't going that much higher. But the thing's moving around a lot more on day 5 than it was on day 1 when you sold the options. And so you might be losing on movement. And the reason why is because this ratio, when you started and sold it from a 119, is now a 0.80, meaning the thing's moving around a lot more than the implied vol is pricing. And that's an issue if you're short options. So it gives you a framework to be able to look at that and understand why things are happening in the way that they are as far as your P&L is concerned. All right, how things might move up. Let's talk about it in terms of real assets. So stock 1, 30 days to expiry. It's a $40 stock. Implied vol is a 70, and the price of the at the money straddle is $6.40. You can look at the Greeks of that straddle. It's got 11 cents of theta, 10 cents of gamma, and the 30-day delivered vol is a 60. So when we do our math, implied divided by delivered, the ratio here in stock 1 of the 30-day implied over the 30-day delivered is a 1.17. Stock 2, same setup, 30 days to expiry. It's a $55 stock. The implied vol is a 50, and the price of the 40 straddle is 6.25. Relevant Greeks are very similar. If you look, and the 30-day delivered vol is a 55. So the implied divided by delivered ratio here is a 50 divided by a 55, or a 0.91. Meaning the implied vol is trading under the delivered vol. In this case, it's trading over. In this case, it's trading under. Some people might look at this situation who are relative value traders and say, stock 1, you should be selling options because it's higher than 1. And stock 2, you should be buying options because it's lower than 1. I'm not suggesting that every time this happens, this is the way you should do it, but I am saying that many relative value traders do trade it this way. They look at certain situations that are priced over 1, and they see that as varying degrees of opportunity to sell options relative to delivered vol. And when they see options that line up in this way, where the ratio is under 1, sometimes they see that as in varying degrees of relative value to be buying options. In this case, if you sold a straddle in stock 1 and bought the straddle in stock 2, your Greeks, which is the kind of interesting part here, is that when you say the Greeks of this straddle versus the Greeks of this straddle, I'm short this one, I'm long this one, your Greeks are going to look very neutral, extremely neutral, way more neutral than if you had either just bought the options or just sold the options, obviously. And you would be considered short the ratio of the two implied volatilities on a 1.4 ratio. Stock 1, the one that you sold, is a 70 implied vol, divided by stock 2, which is a 50 implied vol, which gets you to a 1.4 ratio. So let's assume you made those trades and you made them, 10 straddles by 10 straddles. How things might move when implied vols come down. Remember, we had stock 1 that set up with an implied vol of a 70. That ratio was a 1.17, and stock 2 that had an implied vol of 50. That ratio was 0.91. We think theoretically that these options are slightly overpriced relative to delivered vol, and these are slightly underpriced relative to delivered vol, and we are short this ratio on a 1.4 implied vol ratio. Now, let's say that things move down as far as the ratio is concerned. 30 days to expiry still, but the underlying hasn't moved, and this implied vol goes down from a 70 down to a 55, and this one goes down from a 50 down to a 45. Well, what do you have now? You are short this ratio still, but it has moved down from a 140 to a 110. Keep in mind, because you're short one straddle and long the other one, you have an actual relatively neutral Greek position, but you're short this implied vol ratio between the two. What does this mean necessarily for straddle prices? So we started with being short a $6.40 straddle and being long a $6.25 straddle. So you're essentially, net taking in 15 cents of premium for this entire thing. In this case, you started with a 140 vol ratio. And we just said it moved down to a 110 because the vols moved from a 70 to a 55 and a 50 to a 45. Well, what does that look like for the actual prices of the straddle? Net from this position, you're going to make $1.38 on the straddle moving from $6.40 down to $5.02, and you're going to lose 60 cents on a straddle moving from 6.25 to 5.65. What does that mean? You make 78 cents on the straddle swap. Where does the 78 cents come from? It comes from the movement of that ratio of a 1.4 down to a 1.10. That's what 30 points of movement in the implied vol ratio might mean for something like that when you're talking about a straddle price. Now, it doesn't always move your way, right? So in this case, we have the same setup, except vols moving up and not down. So remember, we're short this ratio from a 1.4 because we're short the 70 vol and we're long the 50 vol. But both of these vols move up. Stock 1 vol goes to a 90, stock 2 vol goes to a 60. Guess what? The ratio is not down, it is up. And instead of being down 30 ticks, it's up 10 ticks. It's a 1.5 now. Well, what does that mean for the straddle prices? You're short this one, you're long this one. The ratio has moved in the opposite direction that you want. We started again with a 140 ratio, $6.40. So the straddle we're short, 6.25. The straddle that we are long. The ratio has moved up by 10 ticks. This straddle moved from a 640 to an 820 price when this vol went from 70 to 90, and this straddle moved from a 6.25 to 7.5 when the vol went from a 50 to a 60. That means in this situation, you are going to lose 54 cents on that straddle swap. The reason why you lost 54 cents here isn't just because vol went up. It's because vol went up more on the one you're short than the one that you're long. And that's the reality of this situation. You can make money on this straddle swap when vols go up, but the vol that you're long has to go up more than the vol that you're short. That's not necessarily out of the question. It's just that many times when these ratios are moving around, they might move in slightly unexpected ways. And when you're seeing things move like that, you again need to dig in as to why this thing is moving the way that it is. It's even as simple as just saying, okay, where's the vol now relative to where it was? Is it priced on the same ratio? No. Okay, it moved. Did it move in the way that I want it to move? Yes. Okay, then I need to either, think about it a different way or take some of it off or whatever. But the idea here is that it gives you an idea to think about where things are, and it gives you an idea to think about how they are moving. So there's another element to this that is important, which is how much the underlying is moving during that same period of time. But I want to leave that for another discussion, or possibly if people have questions about it, we can talk about it. But let's talk about some of the key points of just thinking about this as far as the ratios itself. Historical vol and implied vol are basically the same thing, but looking in different directions. One of them is backward, historical vol, one of them is forward, implied vol, and relative value is really the way that you put those two things together and think about them. These ratios can be used as a reference of how things have been moving over time and how much of that is forecasted in the future. And the power here is the simplicity of the ratio. It has the ability to reduce things down to their kind of like lowest common denominator and help people eliminate some of the idea of what is high and what is low. Because if you're looking at something that has a 10 vol and it's a 10 implied vol and it's moving on a 10, it's fairly priced relative to movement. And if you're looking at something that's a 10 vol and you're looking at something else that's a 90 vol and you're saying, oh, I should sell the 90 vol and buy the 10 vol, I would say, well, okay, that might work, but how much is the thing priced on the 90? How much is that thing moving? Because if it's moving on 130, selling the 90 vol and buying the 10 vol isn't going to do you any good, because one of them is going to move more than it's forecasted anyway. So the correlation of these assets is really important when you're thinking about these things. Oftentimes, I think, especially when you're first starting out and thinking about this, it's best to think about things that are very tightly correlated. So do some research on how the correlation of the movement is actually linked, and start with things that are fairly highly correlated, because oftentimes you can get into really sticky P&L situations if they're not correlated, because they don't necessarily move in the same way. There can be lots of different explanations for why the ratio has moved in the way that it has. Don't just look at a ratio that's moving up and think the implied vol is going higher, because that's not always the case. And oftentimes you need to put in some analysis to figure out what is going on. Is the implied vol moving? Is the historical vol moving? Are both of them moving? Is this something that's, that's more complicated than it looks from the outside? Because inevitably it always is more complicated than it looks from the outside. It requires a little bit of investigation and some forensic digging into what has happened and what is happening currently. But the best part about this, from my mind, is that it gives you a way to think about where things are priced, how much things have moved, and how much things are being forecasted to move over those same periods of time. It can be a motivating factor for just keeping yourself educated as to how the market is lining up. And in many ways, that can be a great way. That's why I call it a framework, right? To think about how things are priced. So try to build that into the way that you think about things. It can be really helpful. And let's see whether or not we can come up with some good questions, Andrew.
Yeah, there are some good questions, Matt.
This is always kind of a wonky subject sometimes to talk to, because it can be kind of, like complicated to think about.
Yeah, there's questions on is IV and HV reported? Where can I get them? Well, you can certainly configure Trader Workstation or the desktop or any of our platforms to report historical volatility and implied volatility if you want to, and that information, maybe I'll be able to share my screen in a moment and just show you how to do it in TWS, but definitely there. People are asking also, well, Matt, do you have any additional thought on that? Do you show that data on the OIC website?
Right, as far as this deck?
Well, yeah, I mean, volatilities in general. I mean, it's probably best to do it in your broker platform, isn't it, really?
Oh, yeah. I think it's best to start with your own brokerage platform. Those are, number one, going to be more relevant to what you're trading, and they're probably going to be more relevant to what's happening right now as far as time is concerned. We have volatility tools on the OIC platform, but they're really, I want you to think about them as kind of like teaching tools, not necessarily tools that you can use to evaluate like current market moves and moves in implied volatility. For those things, I want you to focus more on the data that your broker is giving you, because that's going to just be more relevant to the market.
Sonny is asking, how does a similar strategy work around an event? Should you compare relative to the previous event, say earnings, instead of normal 30 to 90 days to expiration?
Yeah, amen. That's a great question. So I want you to think about this in terms of, you're trying to kind of build some sort of framework around what you can expect going forward. And so in that way, if you're talking about something like earnings, it might be particularly instructive to go back and do exactly what you said, Sonny, which is look at, okay, I have, 10 or 20 of the last earnings situations that have existed for this stock, and the 10-day straddle previous to the earnings was priced at this vol, and the move was at X historical vol, and be able to look at, what I would encourage you to do in that situation is go back and look at how each one of those ratios moved, and then think about where the ratio might live in that range of values and whether or not the actual ratio that you're seeing currently is actually in that range for whatever reason. Do people expect the same amount of movement? Is it priced particularly low relative to how things have moved in the past? But the way that you can think about that, and I think it's really good that you brought this up, is you want to be comparing events. If you're thinking about doing this for an event trading strategy, you want to be comparing as many of the similar events that you have seen, and earnings is a particularly good way to line that up because it kind of is the same every single time with the exception of the move that happens and the numbers that they release, right? The build up to it is kind of always the same. They tell you when the numbers are coming out, and then there's a 2-week period where, like, you know, no one can say anything and the whole 9 yards. It's a good way to build in some kind of event forecast and be able to build that framework around, okay, how much have things moved in the past? How much did vol get bid beforehand or offered beforehand, however it moves? And then how did that, make sure when you look at that, you also look at how did the ratio move after the event? Because so much of that and so much of the P&L of that situation is going to be post-event. How do the options kind of resolve the uncertainty that was built into the marketplace beforehand? So I think it's a particularly useful tool in that regard as well. Keep in mind when you're trading events, they can be kind of like binary moves and can be kind of scary, particularly when you're short options in something that's moving. And so, you know, always keep in mind that you should be sizing these positions relative to your own kind of risk criteria and your own risk tolerance. So that would be my advice on that front. But I think it's a good question and a good call out for the earnings side. Very good.
Jeremiah asked the question here, on the examples you used where you were long one straddle and short the other, do you have predetermined profit or stop loss criteria? And are there any situations where you might manage one straddle but not the other?
That's a really good question, a very insightful question, actually. Many times, like I said at the very beginning of this, people who trade relative value like to look at it from a close-to-close basis and then hedge on a close-to-close basis. They evaluate the situation and the lineup as if it were close-to-close volatility and then hedge it that way. However, there are certain circumstances where, for instance, let's say you're short one straddle in one stock and you're long another straddle in another stock, and something completely unexpected happens, and in the straddle that you're long, the thing moves 5 standard deviations or 6 standard deviations or something crazy that it is something that you would obviously never expect to be reflected in the other asset that you're short. And in that situation, you would be hard pressed to say to me, well, I'm still going to wait and just hedge this thing close to close because that's how I evaluated it. I would say, well, yes, you did evaluate it close to close, but these are seemingly extenuating circumstances where this thing has moved an exceptional amount, and you might want to realize some of that P&L by either hedging the gamma that you have on the long side, or, for instance, many times when I've traded these things and something like that has happened, I would just take the whole thing off because you got so much P&L out of the thing, and it's some like crazy, non-standard event that you didn't really expect. Sometimes those situations can call for hedging or taking off the position just because of their nature. I would say, generally speaking, when we were trading this in good size, we were constantly monitoring. Let's take that situation that I just talked about out and say, okay, let's assume that you're just seeing kind of normal market movement, but you're seeing outperformance on the side where you're long. Like the thing is, you're hedging in a profitable way more on the side that you're long on a daily basis. We would talk about it in terms of, well, what is the ratio delivering right now? If I were to hedge right now, right? Like halfway through the day, we would look at it at noon and say, what's that thing delivering? And if it was delivering if we were long the ratio and we had bought it for a 0.91 and it was delivering a 1.5, there were times where we would say, okay, maybe we should hedge this because it's more than a full standard deviation away or something along those lines. I would encourage you to, if you're going to do that, build in some ideas of like programmatically thinking about how you hedge, because just doing that and kind of like, seeing which way the wind blows gives you a little bit too much leeway to allow your kind of monkey brain to like mess things up. And when you're dealing with it on a purely mathematical level, it's best, I think, to try to make it as systematic as possible. So if you're going to kind of dive into this in this way, I want you to do some thinking and maybe some research as to how people hedge it and how you can think about that going forward. But there are circumstances where one straddle gets hedged and the other one doesn't, or, and some of those are what I described, but that's certainly not the entirety of all of the ways that it can line up. But yes, the answer to your question is yes, there are circumstances in which one straddle could get hedged and the other one would not be hedged, and that's one of them.
All right, Matt, I'm just going to take the screen back from you for a second, then we'll come back to your closing page there.
Yeah, indeed.
I want to show people the trading workstation. This is just a simple watch list where I've just got some basic information up with the symbol, the traded price, the change. If I use that top line there, click right and select manage columns. Over on the right here, the available columns that are not displayed, here's what I do have on the middle of the screen: the average volume, the name of the instrument, the last of the change, and the change percent. If I come over to the right and locate options, you'll see that I can scroll down and select the historical volatility close. Let's highlight it. In fact, highlight implied volatility percent as well, and click add to add those both. We'll use them as last columns there. Click apply and OK. So now, not sure why the implied vol isn't actually showing up there. It sometimes happens in my paper trading platform, but I think we should have the ratio somewhere too. Let's see if I've got that on the managed columns, options. No, I'm not seeing it right there. Okay, but I know we have scanners in here as well that will show you the highest implied volatility over implied vol and the lowest and so on. So that's how you would add those two values to the platform. I think, did you miss that? Was I sharing my screen? Did you see that?
There. I couldn't tell if it was happening the whole time or not, but I see your screen now.
Okay, hold on. Yeah, hold on. I think I missed I didn't click the button. Okay, so let's just do that again. I've added the implied volatility column there, and the historical volatility closing value there as well. And all I did was to click right in this top line here where my column headers are. Click right, manage columns, and then from the available columns on the right, go to options, and then the values that I just pulled were in there. So closing implied volatility percent, for example, there's the ratio I was looking for, the implied vol over the historical vol percentage.
There you go.
Highlight that, click add. There it is on that side now. Click apply and OK. And there is that ratio that we were talking about. So the historical volatility, the closing historical vol is displayed in that column. The implied vol, for some reason, as luck would have it, is not displaying today. But there's the ratio of the two, the implied over the historical volatility.
Yeah. And oftentimes brokerage platforms will allow you to export implied vol and delivered vol data. And you can also build these things in Excel quite easily with downloaded data. And that's always a possibility as well. The thing that I think is really great about these is that it's a pretty simple mathematical, there's not a lot of complicated math here. It's one number divided by another number. The complicated part is being able to look at why these things are moving and possibly, like how and why. And so I think that's really the part that's interesting, because you're really just dividing one number by another number, essentially. It's good, though, to see that IBKR has the actual ratio itself there, and that you can just look at it and add a column to your option montage and be able to see that as well.
I've just brought it back to your final slide there, Matt. Did you mention your education at the OCC?
Yeah, absolutely. I appreciate it. So OIC is really the Options Industry Council. It's where all of our educational resources are held. And if you're looking for more educational resources as far as options are concerned, make sure to check out optionseducation.org. You'll see it at the very bottom of that slide. And then you can send us email questions at options@theocc.com. We answer, like I said, almost 5,000 email questions a year, which I was kind of surprised by, but it's a big number. And the reason why is because we answer questions about options all day, every day. So send us email questions whenever you run into hiccups or questions or just want to talk about options, because we're all a bunch of option dorks and we like to talk about options. So that's about all I have today, Andrew. I really appreciate you guys having me. I'll be back again next month, sometime early in DEAS, to talk about something else. I'm not sure what yet, but I'll be here with lots of options information.
Brilliant. Always a pleasure. Thank you very much, Matt Cashman from the OCC.
Thanks, Andrew.
Bye for now.